What if I told you that you could own commercial real estate, collect passive income, and build long-term wealth without managing tenants, fixing toilets, or making big decisions? See, most people think investing in real estate means that you have to become a landlord, but that's simply not true. Today, I'm breaking down why commercial real estate investing is the best passive investment that you can make and how you can get started without doing any of the big work. See, you're working hard, you're saving money, and maybe even investing in stocks. But what if you could make your money work harder for you? Commercial real estate comes in. It's been a wealth building tool for the wealthy for decades, but now anyone can invest passively. By the end of this video, you'll understand why passive investors love commercial real estate and how you can personally start earning passive income without managing a single property. I'm going to cover 3 big reasons why passive investors should consider commercial real estate, plus some key mistakes to avoid as a beginner. One of the biggest reasons that investors choose commercial real estate is pretty simple: higher returns and consistent passive income. Why is this? Comparably, stocks go up and down. Savings accounts, they don't keep up with inflation, but commercial real estate offers you steady and predictable income because rents are collected every single month. And as a passive investor, you receive a share of that income. Why is this so important? Why is commercial real estate investing so attractive to passive investors? Primarily, you have the opportunity for much bigger profits in single-family home investing. More tenants equal more income, steady rental payments every month, lower vacancy risk, income from multiple tenants. If you lease out a single family home, you just have that one person or that one household who you're collecting rent from. If you have a multifamily apartment building or a retail space or a flex space, you have multiple tenants who are paying rent each month, which gives you predictable cash flow. And on your part as a passive investor, there's no active management needed from you. There's no active management needed from you. So let's paint the picture. Let's say that you invest in an apartment community through a syndication. Every single month, the property generates rental income. Then the expenses get paid by the property manager, and then distributions of profits go to investors like yourself. So how does that look? So let's say that you are an investor in a 100-unit apartment building. Each tenant pays rent every single month. There's vacancy in 1 unit. 99 still pay. Compare that to a single-family rental. 1 tenant leaves, 0 income. Commercial equals multiple income streams, which is what we all want. Stable cash flow every single month. Less financial stress for investors like yourself, and your wealth grows passively over time. Have you ever checked your investment portfolio and absolutely panic because the stock market dropped overnight? Well, with commercial real estate, that just simply doesn't happen. Commercial properties provide long-term stability because they're backed by real physical assets. Unlike stocks, which can swing widely based on headlines, real estate values tend to appreciate over time. Plus, people always need places to live and work and shop, meaning commercial properties generate steady, even cash flow, even in economic downturns. The reason why that is commercial properties provide long-term stability because they're backed by a real physical asset. There's always going to be a steady demand for properties, and there's a number of types or asset classes of commercial real estate properties, which we will learn about soon. Housing is always going to be needed. A place to do business is always going to be needed. Therefore, that is why cash flow is still steady even in downturns. That's not tied to market swings. The value of the property is more so tied to the value of the businesses that run within it and the value and size and structure and type of the physical asset. Rent, whether it is for residential or commercial, tends to pretty much keep up with inflation. And banks really favor real estate loans. Think about it like this. During a market crash, stocks can lose half their value in a day. But in a well-leased apartment complex or office building, how does that look? The tenants are still there. They're still paying rent. They're still keeping your investment safe. So breaking that down a little bit more to continue to compare, Market crashes, stocks drop by half. Investors panic, sell it all at a loss. Real estate, still generating rent. Tenants keep paying their leases. Businesses do not move out overnight. If anybody watching this has ever been a landlord and you have something that's called a skip, where your tenant stops paying rent, they stop answering the phone, they don't answer the door, you go do a check and realize that they're gone and they've trashed the place. Businesses do not do that. Going back to apartments, they are always in demand. Why? Because people always need somewhere to live. Property values over time tend to trend upward. Unlike the stock market, there are no daily price fluctuations, which makes my heart happy. And passive investors stay worry-free. Long-term security, steady cash flow, win-win. Did you know that when you invest in commercial real estate passively, you don't just make money from rent, you actually get paid in multiple ways? See, unlike a paycheck or stock dividends, passive investors in commercial real estate benefit from cash flow. You get monthly or quarterly payouts from the rental income. Appreciation. As the property value increases, so does the value of your investment. Tax benefits. Depreciation and other write-offs, that'll reduce your tax bill. Who doesn't love that? Equity growth. As the loan is paid down, you own more of the property. Cash flow from rental income, property value appreciation, loan pay down builds equity, tax benefits reduce taxes, inflation increases rental income. So many benefits. A great example of this. So imagine you invest in a multifamily property. Over the next 5 years, the property appreciates in value. Rents increase. And by the time it's sold, you've doubled your initial investment, all without managing tenants or dealing with property maintenance. Years later, usually 3 to 5 years on average, property is sold for a profit. At that time, all the investors receive a lump sum payout. The stock market averages have nothing on the total returns that are expected during a commercial real estate sale. Before you start investing, there are a few common mistakes passive investors should avoid. Mistake number 1, investing without understanding the deal. Not all commercial real estate deals are the same. Always check into who's managing the property and what the expected returns are. Here's an example of things that can go wrong. You see an ad, 15% returns. You get excited. You invest without researching. Turns out the property has a high vacancy. The market demand is weak, so the rent drops. Operating costs are underestimated. Returns are lower than promised. You were originally supposed to be locked in for 3 to 5 years. Well, now you're locked into 7, and there's no early exit option available. Now you're stuck in a bad investment for 7 long years. How do we prevent things like this from happening? Get educated in a place like this with someone like me who will teach you how to do due diligence to prevent this. Common beginner investment mistake number 2. Have you asked, how long will my money be invested? What happens if the market changes? See, a good syndication plan will have a clear strategy for when and how the property will be sold. How this goes wrong. You join a syndication. You're told that, hey, in 5 years, we're going to exit this deal, sell the property. Well, the market slows down in year 4, and the property cannot sell at the original target price. So now the whole period extends to 8 years. But you need to cash out at year 5. And there's no early exit plan, so you cannot get your money out early. Your returns are delayed, your life plans are disrupted. How does this happen? Because the exit was not clearly planned by the team. Now you're stuck waiting on market recovery. Common beginner mistake number 3. Commercial real estate offers huge tax advantages, but only if you use them. You need to work with an expert to maximize your deductions and grow your wealth faster. Here's a scenario. You earn $50,000 in real estate returns at the end of a deal. You pay full taxes on the income. And then months later, you hear about this great thing called depreciation. You could have written off the property expenses. You missed a 1031 exchange opportunity. Now you paid thousands in unnecessary taxes. You could have reinvested those tax savings for more growth. Lack of planning can equal lost money. A simple tax strategy could have changed everything. So now you know why commercial real estate is a smart choice for passive investors. It offers higher returns, more stability than stocks, and multiple ways to build wealth without managing tenants or making big operations decisions. If you are interested in learning more, drop a comment below with invest and let me know what your biggest questions are about passive real estate investing.